Well, why target date funds might be the wrong option for your 401k plan. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I want to invite you to go to the website at www.prudentmoney.com. When you do get to the website, just go find the link at the top of the page and ask the question, and I will get you an answer. That's off the website, www.prudentmoney.com. You know, one of the things that I say is very important when it comes to stewardship and it comes to money is to understand both sides of the subject that you're talking about in as far as money goes. The pros and the cons. And most people go through a process which I call belief renting, and they hear it someplace that let's say XYZ stock is a great stock to be invested in, and that's supposed to be purely made up. I don't know if there is an XYZ stock. And they're told how great it is, and so the person is having a conversation with his friend, and the friend goes, "Why are you investing in XYZ stock?" And he goes, "Well, I heard over the financial media it was a great stock to be invested in," but doesn't really know why. The only way that you can own your beliefs about anything when it comes to money is be able to explain why you believe the way that you do, and the only way that you can do that is by understanding both sides of the story. So this isn't a program today on pro or con when it comes to target date funds, or if it's with Fidelity, the Fidelity Freedom Funds. They're both sets of mutual funds, different companies that do the same thing. They basically, if you're say you're going to be retiring in 2035. Well, 2035, you would invest in the 2035 fund, and every year that you got closer to that date, your retirement date, theoretically, the fund is supposed to reduce the risk, putting you in a very good risk-reward balance for retirement. And that's what they advertise. And what's interesting is the amount of people who are invested in these target date funds. 64 cents of every dollar are going into these funds. If you have a situation where they sign you up for a default 401k plan, so in other words, you didn't initiate it, you didn't sign it up, it was part of the process of being employed, they're probably going to use this target date fund. But we're going to take a hard look at this, and because so many people are using them, and see if this is something that is right for you. There's such a fit for the philosophy of pop culture finance. I'll never forget, I was watching something on TV, and they had a commercial come up, and it was a Fidelity commercial. In this commercial, there's a guy interviewing a couple, and the guy goes, "Well, so tell me, Mr. Smith, what are you invested in when it comes to your 401k plan?" He goes, "Oh, I just put money into this target date fund, or this freedom fund. It'd be freedom fund, by the way, this freedom fund." And the guy goes, "Well, tell me a little bit about how that fund is invested." He goes, "I don't really know." He goes, "I just know that it's just taking care of itself, that there's really nothing that I have to do." And this fits so very nicely into, as I said, the philosophy of pop culture finance. It's easy to understand. You find your retirement date, you start investing in the fund, and that takes care of everything. You just save money. I can't tell you how many times I've seen an article come across Yahoo's Finance or something like that, that claims you can save your way to retirement. There's much more to it than just saving, as you know. Of course, in the pop culture finance philosophy, you don't touch anything, you don't change anything, you just leave it to the fund managers to change the risk levels. And they are the answer. Well, maybe not that easy, but they are the answer according to people in the 401k universe. So, what I wanted to do was talk about where trillions of dollars are being placed. And now, I know that, what's interesting is that the this is target date funds, I think it's because of their popularity, are all of a sudden starting to take some criticism. And I thought it took very long. I've been talking about this for a long time, and it's just now starting to get criticism. And so some of the reasons why people don't like them, they balk at paying the fees these funds charge. On average, target date funds cost 0.68% a year, according to Morningstar Direct. Here's something that you've got to remember when it comes to fees. Now, I'm not oblivious to the fact that there are so very many investments with excessive fees when it comes to the mutual fund business, or really any type of business that works with people's money. There are excessive fees. 0.68% is not an excessive fee. And the lower the fee, the more passive that fund becomes. In other words, the lower the fee, the bigger the roller coaster you're going to be on, because the fund doesn't do anything, because you're not paying it to do anything. 0.68% is paying for a strategy. Now, as you know, I'm a big believer in strategy, so the target date funds and the Fidelity Freedom funds, I will give a pass to a certain degree, because they are at least running some type of risk strategy. Now, it's not one that I think is the absolute answer, or the one that's going to get you there the easiest way. I think there's more to it than just moving it based on your age. But hey, a strategy is a strategy. As I said, this is the default choice for millions of retirement savers who are automatically enrolled in 401k plans. Another thing that I don't agree with. The other issue that you're starting to see in print now with these age-based funds is that the one-size-fits-all approach that they take no longer works when they reach certain financial and life milestones. Retirees, for example, sometimes retool their portfolios to buy investments that generate income, such as dividend-paying stocks. You see, this is what I think is missing when I start to read these things, and this particular article was chock full of great information that I think we can take, and by learning the other side of the story, you can really get a good education on what's going on here. Dividend-paying stocks, they may pay out some income, but you got to remember, as far as risk goes, they still take a hefty amount of risk. If you're trying to reduce risk, adding dividend-paying stocks may not really be the answer, because at the end of the day, it comes down to how much you have invested in stocks. Now, if you decided that, hey, I only want, 45% in stocks, and you invest all into dividend-paying stocks, that's one thing. But I would agree with the criticism on it, is that when you do get to retirement, I don't know that dividend-paying stocks is necessarily the answer. There are a lot of changes that you do want to make. The third, and this was a criticism of these funds. Some people, investors, simply want a more aggressive strategy than their target date funds offer. To me, I think it's very, very simple. If you are wanting more excitement in your investment life, more aggressive, something that's a little bit more aggressive in your investment life, then go open up a small slush fund and invest aggressively and see how that works for you. Don't I personally, unless you've got a solid plan A and a solid plan B, and you're willing to change things and invest for risk and that kind of thing. I don't think it's a good idea to take all of your retirement assets and get aggressive with it. That's just my opinion. Boring is sometimes a good thing. Mutual funds are nothing but boring, except for the real aggressive ones. And you have to decide if that's the right thing for you. Here's they printed a bunch of different stories and cases of investors and things they said, which gives you a really good idea of how they believe. It says having 10% in bonds now doesn't sound like much, Hurley said, but it was a red flag to me. And she's right. I was telling somebody today about a recommendation they received from another advisor, and it was 75%. They recommended that you go down to 75% stocks, 25% bonds. I don't think that you start to get the true benefit of diversification. Some may argue with this, but it's just what I believe. Until you get 50-50, and then you go down from there, is when you really, I think, get the advantage of diversification. 10% in a bond fund, 90% in a stock fund, doesn't even move the needle, as they say. I think she's absolutely right about that. It is a big red flag. Why I don't care for target date funds or Fidelity Freedom funds, I'm going to cover with you on the other side of this break. This is Bob Brooks. You are listening to the Prudent Money Radio Show. Stick around, and I'll be right back. Hi, my name is Bob Brooks, host of the Prudent Money Radio Show. So let me ask you a question. Do you know your numbers? Now, which numbers are those? They are your retirement numbers. That set of numbers is the single most important planning numbers you can know. Yet the majority of Americans don't even know them. Prudent Money Financial Services, sponsor of the Prudent Money Radio Show, specializes in figuring out those numbers and creating a game plan to make sure you're on the right track. Listen to the Prudent Money Radio Show weekdays at 3 p.m. on Bible School Radio 91.3.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need. So please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Let me tell you the issues I have with target date funds. First, they are marketed to leave it and forget it, which I think is the wrong approach when it comes to investing your retirement dollars or any in dollars as far as that goes. They still, in some cases, I think, take too much risk. Because I look at everything as, just to give you a good example, money to a percentage that is broken up into international stocks and then domestic stocks, they look at that as two big areas of diversification when it's not. They're all stocks, they're just different types of stocks. And typically in this environment, when a certain kind of any stocks go down, they all go down most of the time. So I would say the good majority of the time. Then there's times where it may not be that way, like in 2000 when value stocks funds came back. They are a strategy, but they are a strategy, not necessarily one that I think they kind of start you off in a strategy. There's other things that you should do going forward, but there's a big deal from buying and holding and taking a loss and having a strategy to protect from risk, which I still think and very strongly believe in is a very important principle of stewardship. Then they diversify just diversify. What I mean by that is they kind of over diversify, but if you look at what they're doing, you have to ask the question, in order to get really good diversification, one investment has to move one way to offset the other one, which is moving downwards, and you don't always see that. Back to Miss Hurley. She says, who works in the compliance of a financial services company, hired a financial advisor to help her plan for retirement, which I think is a great scenario for people to consider, because you've got all your money sitting in your biggest retirement account and you don't have an advisor to work with. I think you should get one, but I got a bias there. Their advisor showed her that if she continues to save 5% a year for the next 45 years, she could miss out on as much as $130,000 in gains by age 65, compared with investing 100% in stocks for 25 years before switching to a mix of stocks and bonds. Quite honestly, that made my head hurt. She could miss out on as much as $130,000 in gains by age 65. They write these things and they make these statements as if it's so true, because the past always predicts the future, and if you stay in it long enough, you'll always be fine, no problem. Then, of course, after that 25 years of aggressive investing, you switch to a mix of stocks and bonds. Anybody who's been investing the same way for 25 years is probably not going to all of a sudden start. Incidentally, I have to mention that you probably in most 401k plans have a stock index fund that only invests into stocks, like the S&P 500 index fund, and a bond fund. You can do a lot of diversification with just those two funds. And you might be saying, that's just two funds. It's two funds that have hundreds upon hundreds of stocks and bonds mixed up that are represented in those two funds. And do you know, for those of you who love a little bit more aggressive investing, that the S&P 500 is roughly 30% made up of AI stocks. In fact, the leader of all AI stocks, artificial intelligence stocks, is NVIDIA, and that is, I think, 7% of the S&P 500. So just kind of keep that in mind as you think of things. Philip Hamilton switched from a retirement plan with mostly target date funds to one that includes index funds. He's doing something that I think, once again, is the right way to go. A combination of bonds and stocks and making that aggressive or more conservative blend, to me, is the way to approach things. And using index funds, because index funds are generally a little bit more predictable as to what they're going to do, because they are tied to say, for instance, the S&P 500 index fund. Says Philip Hamilton, a 61-year-old supply chain manager, has put up to 20% of every paycheck into his 401k since his 20s. Last year, his employer said the fund his 401k money had been in was closing and offered employees a different variety of options for where to move their money. Most of them were target date funds. If you get a note that says we're switching funds up, and I think this is happening to a lot of 401k plans, because as fiduciaries of those 401k plans, a committee, a certain amount of ownership, whomever it is, the company, they always have liability if they're not making decisions and moving funds out, moving funds in. So when they move funds out, they move funds in, they look for funds that they can put you in if you haven't responded to how you want this to be taken care of, which most people don't. Then you find out one day, for the last 2 or 3 years you've been in an index, a target date fund, and you're not happy about what's happened. Says, though, that Philip Hamilton instead, he went with a portfolio with about 80% in stocks, including index funds, and 18 companies in the oil, gas, and defense industries. And I think more people are investing on their own as opposed to doing these types of investments. Then the article says, and I only read this because I think it's important to make the point, since 1926, U.S. large stocks have risen an annualized 7.19% after adjusting for inflation, far exceeding the 2% gain for U.S. long-term government bonds. According to Morningstar Direct, but advisors and others caution against going all in on stocks. That's smart, because U.S. government bonds often rise when stocks fall. Those with diversified portfolios can easily stick with stocks during their bear markets and avoid missing out on a rebound. Generally speaking, but not always the case. I mean, you don't know. If you look at anything, nobody's been invested probably since 1926, and they act like if you just invest between this time period, this is what the next time period's going to look like. Got to be very, very careful with that. This is another case, Joa, I was going to say Joa because I can't pronounce his last name. 57 and his, I don't want to butcher it, 57 and his wife started contributing $400 a month to a target date fund in a 529 plan as soon as her daughter, 18 was born. The returns were modest. So in 2013, the Newton, Massachusetts resident began putting his contributions into an S&P 500 index fund instead. That fund grew to about $109,000 by 2024 and significantly better outcome than the target date would have generated. Of course, it's going to be a bigger outperformance and better outcome because the S&P 500 index funds take a whole lot more risk and than these target date funds. And the target date funds, their whole goal is not to beat the market. Folks, you got to be careful when it comes to 529 plans and make sure that you reduce risk when you're getting so close to having to need that money. I cannot express that enough. And people don't manage the if you can't do it yourself, get somebody to help you, get an advisor to help you because it's just so imperative. Too expensive. Target date funds can have higher fees than many stock index funds. Of course they do because they're running a strategy. It costs money to pay people to do that. Given that they automatically rebalance from winners to losers and shift toward a more conservative investment mix over time. Kelly Palmer says she and her husband Michael want more in stocks than his target date funds provide until they are within 15 years of retirement. Not a bad idea. Michael Palmer, 35, balked at the cost. The Chicago resident was automatically enrolled in a target date fund, and he and his wife recently decided to sell their target date fund in the former 401k plan, which charges 26 basis points a year, and replace it with a stock index fund and an international stock fund that costs 0.02% and 0.03%. Hey, if you're willing to take on the risk, it's you can do that. He's stuck with the target date fund in his current employer's plan, which charges 0.32% because there are no lower cost options. That was his former employee 401k plan, and that's what he's doing with his current. So it's interesting to get different opinions, and I think that people are. The one good thing about the environment today, with a caveat, is that people are really starting to get educated on how these things work and understand the pros and the cons and really start doing some of these things themselves and paying attention. And so I would suggest as we wrap this up that the concept of target date funds is not a bad concept at all. Just the way they're going on, the mutual fund industry is going on about how they implement that and how they teach people about them. If you can get to understand the differences between bonds and stocks and how much you have invested in each, and move that like a lever. Move it down if you want to take less risk, move it up if you want to take a little more risk. Doesn't always work. Nothing always works, but it's something that I think can give you an option as opposed to riding the roller coaster. If you have a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.